So question 1, with reference to your working paper 1, you need to look for concerns with the questionnaire completed and then any concerns with the client acceptance procedures. So my first and foremost step is going to go into that questionnaire, and where I had noted any concerns in my reading time, I'm going to put those down immediately so that I'm getting marks straight away. Once I've done that, I'll then come back to this analysis and see if there's anything I'm missing that I can now go and start to go back into the questionnaire and make sure I have considered that. So I come to my questionnaire, and the first thing I've got here is management integrity, because they are not allowing the auditors access to the previous auditors. Okay, and that, guys, is also addressed in my CPC. So I want to quickly go to the CPC dealing with the appointments and then change in appointments to show you how that would be a concern. So I could put it down under the ethical requirements and then also put it down under management integrity, because the two are linked. Section 320, professional appointments. Guys, again, I don't expect you to know the sections, but I do expect you to know that this is covered in the CPC. So you would go to your part 3 and then look for the specific section if you haven't already flagged this in your standards. Professional appointments, and then you come to 320. Okay, and it tells us there could be threats to integrity or professional behavior if we are concerned with the practices of the client. And it says some sort of issues could be illegal activities, questionable financial reporting practices, dishonesty, or unethical behavior. Now, this is not what I was initially talking about, because what we were initially looking at is the fact that they said we could not contact the previous auditors. But from this, I've already now picked up an additional threat, because they do have dishonesty or unethical behavior in the previous financial manager having or being found guilty of fraud. So I can go and add this. There is a self-interest threat to integrity or professional behavior because of the fraudulent financial reporting of the previous financial manager. Then we have to look at the significance. It says, look at the knowledge of your clients, which we don't really have, or have the clients committed to address the questionable issues? And in this case, they have. So I can go and say, oh yes, based on the fact that they have tried to implement controls, I'm comfortable that it is not a significant threat. So here I've got one issue that I need to already address, and I can go and put that down. So I'm doing question 1, and I'm going to have some headings. Ethical requirements, and I'm going to say here, what's the situation? The previous financial manager was involved in fraudulent financial reporting. Okay, so now what does that mean? Per the CPC, this creates a self-interest threat to integrity or professional behavior when accepting a new client who lacked integrity as a result of that. And I'd say it is not significant because management have implemented controls to address this going forward. Now, I've already not put down this as a concern with regards to management integrity. So I need to go and put that under my heading of management integrity, because that is a section I have to adhere to as part of pre-engagement. So I'm going to have a new heading down here, leave some space, management or the client integrity, and I can say the previous financial manager was involved in fraudulent financial reporting, indicating a lack of management integrity. Guys, you'll have to write out financial manager. I'll go back to the CPC. And reason being, because I'm now looking at this client acceptance section and seeing if there's anything relevant to us. If we don't have the necessary skills or competence, that's not an issue because we've proved in the situation that they do, so I'll keep moving on. Changes in professional appointments, and it says, if there has been a change, we need to look for reasons as to why we should not be accepting this, and that would be in the case if we are replacing a professional accountant, which is the situation. It says there could be a self-interest threat to professional competence and due care if we accept an engagement before knowing all the pertinent facts. So we now have this. How can we consider if it's significant? We need to obtain or request contact with the previous accountant, and then safeguards, asking the previous accountant, which we've not been allowed to. So if that's not allowed, then trying to get information from another source. It does, however, say if the client fails to give permission, then we should potentially decline the appointment unless there are exceptional circumstances. Okay, so provided we feel that these are exceptional, we can discuss that. So I'm now going to go and put this additional threat down. This will go under my ethical requirements, so I'm going to say this is a change in appointment because previous auditors resigned, and then I'm going to say this can create a self-interest threat to professional competence and due care if we accept without knowing the relevant facts. You can say, yeah, the significance, you need to say this is significant because permission to contact previous auditors was denied. So safeguards would be to use alternative measures to obtain the information required, or decline the audit. I can now go and add this once again to potentially management lacking integrity because they didn't give us access to the previous auditors. There's a potential lack of integrity as management have limited our scope in that we are not able to contact previous auditors. And guys, I want to take you quickly to ISQC 1, where they actually give you examples of where the client is lacking integrity, to show you how this would be one of them. Unfortunately, ISA 220 doesn't give you examples of client lacking integrity, so I'm not even going to take you to there. Initially, I said to you there are two standards that can help us as auditors, and I said they're the two quality control standards. Both of them have got a paragraph dealing with acceptance and continuance. So 220 and ISQC 1 have the same paragraphs, and then you've got your application paragraphs for those. So I want to take us straight to the requirements paragraphs, and then we'll go into the applications. And then paragraph 26, your acceptance and continuance. What you need to do as a firm before you consider is look at your resources to make sure they're capable, that they have enough time to perform this engagement and are competent. There's some examples of what I should consider. Can they comply with the ethical requirements? And has the client's integrity been considered once again there? These all are included in ISA 220. There are all the requirements for how we determine if our staff are competent and capable, and to determine if the client is lacking integrity. Things that we should consider: are they trying to limit our scope? Not giving us access is a way in which they could. Are they trying to aggressively reduce the fee? That's a point that we want to discuss when we get to that again. Has there been any criminal activities or aggressive interpretation of accounting standards, or in this case fraud? We've got a concern. And finally, reasons for the non-reappointments of the previous firm. Okay, so you can see we've already discussed this as management integrity lacking, and then linked that back to CPC, and we've now just discussed the limitation of work and linked that back to the CPC. So addressing it from an ethical perspective for the auditors, as well as a lack of integrity from the client. So that can be addressed, that has been addressed, this has been addressed. And I can move on to any other concerns that I've got they've got knowledge, I've got that they are compatible. I've now got a concern here because of the financial difficulties. Will they be able to pay the fee? So that's just a business decision that we need to consider, but really needs to be included. But then they are aggressively trying to reduce the fee. Management integrity is lacking. And once again, there's a concern from us ethically. Can we do the work with such a reduced fee? So once again, I'll go into the CPC for that. So I'll first get my mark that I've got here. Management integrity lacking. I can say they are aggressively reducing or wanting a reduced fee. And that means reduced fee, less work to potentially identify those problems. We just saw that now in ISQC 1, so I won't go back. But now let's go to the fees in the CPC, which is section 330. Section 330 says it could be self-interest rates to your fundamental principles, and it says here, quoting a fee lower than another professional is not in itself unethical, but what you could have is a self-interest rate to professional competence and due care if it's so low that they can't actually perform the engagement in accordance with the requirements. Okay, factors to consider this: is the client aware of the basis for the fee, in which case this hasn't actually been discussed, so I can say that this would be how to determine the significance. And then safeguards, either adjusting the fee or the scope, or having a reviewer review the work. Back under ethical requirements, guys, if you haven't left enough space, then you need to just put an arrow and say to be continued at the end, and then start writing it. We'll say that the client will only accept the auditors if they have the lowest fee, and therefore this creates self-interest threat to professional competence and due care. You guys would write that out. If they cannot perform the audit according to the standards because of the reduced time, we'd say it's significant because the client is unaware of the basis for the fee, and so my safeguard adjust the level of fee or the scope, or get your reviewer to review the audit work to ensure that it is at the appropriate standard. Okay, so I've done that, and that I just now need to add my business decision, so another factor. And guys, you don't have to have the headings, but I find that if you have the headings, it's easier for you to remember that there are at least 3 requirements from the auditing standards: the client's integrity, the ethical requirements, and the staff competence and capabilities. But then from your notes, you should remember there were those other business factors. Is there a vacancy? They've noted there is. There was no concern with that, so I could move on. Can they pay the fee? So they are struggling financially. Therefore, concern if they can pay the fee. And I cross that off. Next year, I've got tight deadlines. So the only thing here with a tight deadline is the fact that the work could be reduced once again, potentially indicating a threat to your professional competence and due care. But I feel like we've already addressed that through the lower fee, so don't really think that this is something that we're going to have to add from a pre-engagement perspective. From a risk perspective, yes, but that's what we address when we start looking at the risks at a later stage. Okay, then I've got here a CPC concern because they are going to be in tax return services. So it's going to our CPC and our independence to see how it's covered in order to address it. 604, tax services, go straight to the tax preparation, tax return preparation, and it says here, does not usually create a threat. Why? Because it's usually based on historical information. You don't ignore it because this is the facts. You now have to put this down, showing why you don't believe there is a threat. And so it would go under ethical requirements. If you see now I don't have enough space, so all I'm going to do here is come to the end and say ethical requirements continued, and I'll say they will be doing auditors, will be doing tax return preparation, and then I'll say that this is usually based on historic information, therefore no threat to independence. I do, however, know that integrity definition says we should not be associated with returns that have false information. We are now aware that the previous financial manager was fraudulently financial reporting, so I do want to put that in. No threat to independence, however, there could be a self-interest threat to integrity if they are associated with reports with false information, and I can make a note here based on the fraudulent financial reporting of the previous manager. And therefore they should not be associated with these returns of this nature. Okay, let's quickly go to your integrity definition. Section 111 says you should not be associated with returns that have false or misleading information. Okay, so now I've dealt with that. So I've now discussed all the concerns I picked up in my reading time. So I go back now to my required analysis just to make sure I've discussed everything from a client's perspective now, not just the answers of the questionnaire. So I've done this, concerns with the answers. I've also gone and looked at least ISQC1, and I'm comfortable that all those requirements have been met. I have discussed the client's integrity, where I could pick up that there were issues. I've discussed the auditors, where there were ethical issues. There were no issues with the skills or the competence because they had industry knowledge, they had industry experience. I've discussed my issues from a CPC perspective in terms of client acceptance. So, what is potentially missing? Question asked for concerns, and I had said negatives or non-compliance. There were indications of non-compliance with IFRS, and so from a CPC perspective, as auditors, we have a responsibility to address that non-compliance. So again, going back to the ethical requirements, we've got a role, or at least a requirement, to address the fact that they have not complied. So I'll take you to section 360 in the CPC. Responding to non-compliance, there's a self-interest or intimidation threat to integrity or professional behavior if we are aware of non-compliance with laws and regulations, and here we are aware that there was fraudulent financial reporting. So in terms of the process that needs to take place, we as auditors have to first and foremost go and obtain an understanding of the matter and discuss that with the appropriate management and those charged with governance to ensure they go about addressing the matter. And where they don't address it, we need to determine if there's anything that we need to do in the public interest and either disclosing it to the authority or withdrawing from the engagement. Okay, now this is at a point where we haven't actually accepted engagement yet. So all I would discuss is the fact that we have become aware that there's non-compliance, needs to be discussed with management, and they need to address it. So I'm going to say the previous financial manager was not complying with IFRS, and this occurred in the current year until addressed in January. And so therefore there's a self-interest threat or intimidation threat to integrity or professional behavior if the auditors are aware and don't react. Therefore, they need to discuss the matter with management to ensure that it is appropriately addressed. And now I have gone and discussed everything that I can possibly consider from a pre-engagement perspective. Let's do question 2.